Hello, my dear students. Welcome back. This is Entrepreneurship, and I'm Miss Tania Poveda. Remember that we are studying some financial terms that we better know before starting a business. All right? So today we're going to talk about expenses. As we can see in this picture, it is connected to many things. For example, budget, analysis, fund, price, discount, money, crisis, etc. Right? What it is important is that you remember that this is connected in the accounting of the company, of the business. Right? So last class we were talking about costs. I hope you remember that information because today we're going to study what is the relation between cost and expenses. But before that, let's read the definition of expenses. They are amounts, obviously amounts of money. They are amounts that have been paid or will be paid later for costs that have been incurred to earn revenue. All right, so in other words, it's money that is going out or money that is going to be out when you pay for costs. Something also very important is that it's directly connected with earned revenue. All right? Directly connected with earned revenue here in the end of the line. For example, salaries and wages, utilities, supplies used, advertising, etc. Everything that you have to pay that is going to contribute to earn revenue. All right, knowing this, I invite you to watch this video. It's really short and it's not as fun as I am, I know, but I hope you enjoy it, all right? So here we have the video. I'm going to explain some terms after this. Enjoy it and pay attention, please.
Hello, in this lecture, we're going to define the term of expenses. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of expenses are outflows or using up of assets as part of operations of a business to generate revenue or sales. Key terms here being that we are looking at our goal of the business, the goal generally to be revenue or sales. That's the objective. Expenses are us using up the assets in order to help us achieve that goal. We usually have some idea of what expenses are. If we were to ask someone what expenses are, probably would hear a list of expenses as an answer. But when we actually record expenses, we often get confused in terms of what's an expense, what's an asset. If we purchase something, if we consume our cash through expending it and receive something, is that thing we received an expense or is it an asset? The point in time that we consume that expense, that asset, and consume it, that's when it turns to an expense. For example, if we look at some common expenses, we can look at a phone. If we think about a phone, the phone itself might be an asset because it's going to help generate revenue in the future. The phone bill represents the stuff that we have used, the consumption of the use of the phone. That's what it's going to be an expense because we consumed that portion of it. If we think about a car, again, the purchase of the car is going to be a longer lived thing. It's going to be an asset. The depreciation as we use it and the related expenses in terms of gas and whatnot, those are going to be things we consumed at that point in time. Those are going to be the expense portion. If we think about wages, when we pay wages, that is incurred as an expense as we consume the services of the employees. We think about supplies. Again, if we purchase the supplies, could be an asset because we haven't yet used them. But when we consume the supplies, if it was ink, when we actually print something out, technically that's the point in time that it is now going to be an expense. Meals and entertainment, if we go buy meals, Once again, we're consuming the meals at the point in time that we consume the meals. That's when it's going to be used in terms of a business purpose, if it was a business lunch or something like that. When we think about expenses, what have we consumed in terms of assets? Oftentimes, it's cash that we are spending. Now, if we're spending something on cash and we're spending it on a car, then again, the car would go on there probably as an asset, and then we would depreciate it over time because we haven't consumed the car. If we spend the cash on something like food, meals, entertainment, we are probably going to consume that very quickly. So the cash is going down. You can think of it as the cash is going down. We're buying an asset, but then we're consuming the asset almost right after we bought it with the cash. At the point in time that we use the asset in order to help us generate the revenue, that's when it's converted from an asset to an expense, pretty close to the same point in time in terms of cash going down in the case of meals and entertainment. If it can also happen that we are not spending cash, but incurring a liability. If we purchase that meals and entertainment in terms of a credit card, we have not yet paid for it, but we've still incurred an expense. Why? Because we basically purchased it incurring the liability, and then we consumed the asset that we purchased right afterwards, the meals right afterwards. Therefore, at the point of consumption, in terms of helping us generate revenue, that's when it has been used. A loan also could be going up. So it's possible that we pay for the expense, of course, with the cash, or it's possible that we pay for the expense with the incursion of a liability.
All right. So probably right now you're thinking like, oh, we already talked about this because before I explained you about assets. And before continuing with talking about expenses, I'm going just to review a little bit about assets. I'm trying to hear it's the right picture with no people in it. Okay, remember that assets, and here I'm coming back to a past class when we talk about the difference between assets and liabilities. Assets are the things that you buy to produce something. Usually it is something that you can sell and you can get some cash or some money for this if you need it, of course. Also, they are the things that you can have in your office or maybe online that you use to produce something. When I say to produce something, when I'm talking about a product, also I'm talking about touchable and untouchable products, which is, for example, if it's touchable, right now you're looking at your computer or your cell phone or tablet, or you're sitting on a chair by a table or your desk. Those things that you can actually see and touch is what we call, obviously, touchable products. But when we're using some things to produce something untouchable, we're talking, for example, advice, we're talking about teaching, or probably a legal service, or advertising, or things that actually we cannot touch. Maybe also can be like the signal, the internet signal, or your television signal, right? This is only a review about assets, but I want you to pay attention on this definition of expenses. It says outflows or using up of assets as part of operations of a business to generate sales or revenue. Okay, so look at this picture. Here in the first line, we have the word outflows. And if I explain separately both words, out and flows, we're talking about how the money moves. That's the meaning of flow. How the money flows. We studied this last time when talking about costs. And we have the word out. In other words, it's the money that goes out of the business or of the company during operations. All right, when we talk about operations, we're talking about all the processes and obviously the operations that you need to go through in a business in order to produce something. When you produce something, the main objective or the main goal of producing something is to generate sales. If you generate sales, obviously you're going to receive some money for it, and with profits, it's what we call revenue. All right, so that's the definition of expenses when during this video, right? And my short explanation. I'm going back to the presentation because probably right now you are like this. Are you? No? Maybe yes? All right, if you pay attention to the video, you probably were like, okay, we already studied something like that. I remember I heard something like that. Oh, it's very similar than costs, right? So what is actually the difference between costs and expenses? Right? In both cases, it's money that goes out of the company. In both cases, we're talking about outflows. We're talking about paying things. But what is the actual difference? Well, here I'm going to present 7 differences about cost and expense. Number 1, when talking about the meaning. On the left, we have costs, investments, expenditure made for purchasing assets and property. Expenses are regular expenses required for maintaining the assets properly, right? So let's suppose we're talking about a cell phone, just like in the video. On the left, we have the cell phone. It's a cost. You pay for it, right? The cell phone itself is not going to produce anything unless you use it, right? When you use your cell phone, it means you're going to pay for that service. You're going to receive a bill, and then you're going to spend some money on that service. The money that you use to pay the cell phone service is the expenses. It's going to be on expenses. The cell phone is going to be on the cost, and the cell phone bill is going to be on the expenses, right? So that's the difference in the meaning. Difference number 2, place in financial statement. Probably this is easier or maybe more clear for those people studying an administration career or business career or technical career, right? When talking about financial statements, sounds like really professional and sounds like accounting and a lot of numbers. It's not that difficult. Actually, costs is a balance sheet item, right? Expenses is an income statement item. All right, so students in technical probably know exactly what I'm talking about. So basically it's where you put it in the financial statement. If it's a cost, you put it in the balance sheet item as a balance sheet item, or expenses are going to be income statement item. Again, let's talk about the cell phone example again. The cell phone is going to be in the balance sheet item. The cell phone bill is going to be as an income statement item. That's it. Okay, difference number 3, which in my opinion is extremely important, is the impact on profit margins. All right, so let's read the differences and then we're going to analyze. So, costs, it does not directly affect profit margins of the company. Does not. Did you remember this about last class? Okay, so expenses, they directly affect profit margin of the company. All right, so one, costs do not affect, expenses do affect. Okay, number 4, or motive. I like to use the word the reason. Cost, purchase, addition, of an asset. All right, so the cell phone, that's it. Expenses, payment necessary to generate revenue from these purchases. Again, I'm going to use the cell phone example because it's the closest one we know. You know that, I know that. So, when you buy a cell phone, you actually get an asset, right? You get a thing, that's it. So it's going to be directly in assets. But when you pay for that cell phone service, it's because you're using the cell phone for businesses, of course, calling customers, doing sellings, things like that. So you're actually using it to generate profits. In that case, that's the different reasons why you consider one as a cost and the other one as expenses. All right, say number 5, the difference. Remember, we're talking about differences between cost and expenses. So, impact on capital structure. Remember that capital is not only money, it's not only cash. It can be a building, it can be a car, it can be knowledge. So it can be touchable or untouchable things. Anyway, so the difference is costs impact capital structure if the asset is non-current. Non-current means that you cannot get cash immediately if you sell that asset. That's a short way to explain that. We already talked about this. So it does impact capital structure if the asset is non-current. But in expenses, there is no impact on company's capital structure. All right, there's not impact because you are using it to produce. So actually it's helping and it's going to keep the balance in the company. That's the main difference between cost and expenses when talking about the impact on capital structure. Difference number 6 about impact on liquidity ratio. Okay, so probably right now you're thinking like, what is liquidity? Liquidity. What's liquidity? It sounds like liquid, right? Well, it's very similar, but when talking about liquidity, we're talking about the cash, the money that you can actually have at the right time to pay something. For example, maybe you have in the bank $100, but in your pocket you have 5 cents. In that case, if you go to the store by your house, you want to buy something that is $1, but you only have 5 cents. So the seller is going to be like, I'm sorry, I can't sell you anything. It's only 5 cents. And you can tell this person, yeah, but I have the money in the bank, and you have to wait till the bank opens and then go there, or maybe go to an ATM, automatic telling machine, or cajero, as we say in Spanish, right? So you go to an ATM. So at that moment, with those 5 cents in your pocket, in that case, you don't have liquidity, right? Once the bank opens and you can get the money, then yes, you will have it. So it's that's an example to explain liquidity. And let's see what's the impact on liquidity ratio. When we talk about costs, if current assets impact liquidity ratio, that's when it affects cost. It affects expenses when there is no impact on liquidity ratio. So probably you're thinking like, okay, what? I understand. So in the case of cost, pay attention on the connection between current assets. It affects costs if current assets impact liquidity ratio, right? So in other words, it affects when you don't have liquidity. That's it. In expenses, there is not an impact. It means you can continue using your cash and moving your money. That's other difference. And difference number 7, and the last one. It's an example that's simple. Okay, so when talking about examples in cost, we have fixed asset, prepaid rent, inventory, etc. Remember that fixed assets are those assets that you always pay the same every month, every week, every day. So there is no way you can say, no, I don't need that, right? It's something that you have to pay because you have to pay. It's your responsibility, it's your duty, it's mandatory. So there are things that you can say no. For example, if you have a store, you have, let's say you have a shop in a mall, and then the mall is like, okay, you sign a contract because you're renting this space to sell your products. So if you sell or if you don't sell products, it's not the mall's business, it's your business. So in other words, you have to pay the rent if you sell or if you don't sell products. So those are fixed assets. Fixed because you can't move them. They don't depend on the sellings. You can sell or you cannot sell, you have to pay them, right? It's the same with inventory. Like you have your products, you have the production there in an storage. Well, it is something you have to pay without any doubt, all right? And in the case of expenses, remember that the definition of expenses said that it's outflows that affects directly to the production or to the incomes and revenues, right? For example, here we have raw material. Obviously, it's the materials that you're going to use to produce something. Or we have depreciation, and that's a word that I don't like too much because it's really negative, right? It's like, okay, depreciation is how a product or how an asset depreciate on time. It means it lose value. Like a house, when you buy a house, in the beginning it's a price like really high, but then after time the value is going down. Well, of course, that depends also on the value of the neighborhood, history, patrimony, and that kind of things. But for example, cars, right, or cell phones. Let's talk about cell phones. I'm kind of motivated about that today. So do you have the same cell phone you had 2 years ago or 3 years ago? Well, I do, because I really like my cell phone and works really good. But most of people change their cell phones after 2 or 3 years. Anyway, no matter if you are going to change your cell phone every week or every month or every year or every 2 years or 3 years, the price of that cell phone, if you want to sell it, is not going to be the same as you are buying a new one, or it's not, you can't or you shouldn't sell that cell phone on the same price you got it because of depreciation. No matter if you use it or not, it is out of the house, it is out of the store, it is not brand new anymore, so it's going to lose some value. Other expenses, labor cost. I like that one. So to produce something, you need people. Even if you're using machines or computers, you need people to manage those computers or machines. And you have to pay for that. So that is going to affect directly, hopefully for good, on the revenue and profits of the company, right? So if you want to read more information about these 7 differences, there is a link here that you can check and you can read more. There's not any problem that you get some extra information. So saying this, thank you very much for your attention. I really appreciate your listening to this class from the beginning to the end. I hope you have a wonderful week and see you next time. Bye-bye, everybody.